There is one lesson that the market teaches time and time again, no matter how many years you've been trading. This lesson is that confidence and being right are two completely different things. You can be absolutely certain of your scenario and still end up with a loss. Or you can harbor doubts right up to the last moment and ultimately see your idea play out almost perfectly. That is precisely why, over time, I have come to focus less on predictions and pay more attention to probabilities. The market does not require a trader to predict the future. Their task is much simpler: to identify situations where the risk-reward ratio looks most attractive. A similar situation recently arose in the gold market. After several days of gains, the price approached a key resistance level. Many expected the upward trend to continue, and the technical picture did indeed look strong. However, instead of an immediate breakout, the market began to slow down. Volatility decreased, and each new high proved increasingly difficult to reach. At times like these, I try not to draw definitive conclusions. Instead of asking, will the price go up or down, I ask myself another question. What will the market show if one of the scenarios turns out to be incorrect? It is precisely this approach that helps me remain flexible. Ultimately, gold formed a false breakout above the resistance level and quickly retreated back below it. This served as an important signal of a shift in the short-term balance of power. The trade arose not because of the level itself, but due to the price's reaction to it. This principle works just as effectively in the equity market. Sometimes investors focus too much on the news and lose sight of the price action itself. Meanwhile, it is often the market's reaction to the news that proves more important than the news itself. With experience comes the realization that flexibility of thought becomes one of a trader's key advantages. The more attached a person is to their own idea, the harder it is for them to notice changes in the market picture. That is why today I try to treat every scenario as a working hypothesis rather than as the truth. The market is under no obligation to confirm anything. Its role is to move in whatever direction market participants deem appropriate. My task, on the other hand, is to observe, adapt, and make decisions based on facts, not expectations. And the longer I work in the financial markets, the more convinced I become the consistent results come not from those who are most often right, but from those who can quickly admit when they are wrong and move on without getting carried away by their emotions.